Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris Rapeseed, Winnipeg Canola and Malaysian palm oil markets.
Paris Rapeseed. Since mid-June until October, the market had been trapped between two congestion bands, one below between 438 to 445 and 3/4, and another one above between 513 and 3/4 to 519 and a half. During this incarceration, the market constructed a head and shoulders pattern, which still looks a lot like a head and shoulders top right now, as well as having an extension to its second shoulder from mid-August until the start of October. I've highlighted the neckline for this head and shoulders top in dark blue on my daily chart. Currently it's at 458 even. The problem the market suffered during the time of its testing down of this neckline had been the sheer amount of force necessary to push down through this head and shoulders top neckline and try and fulfill targets below. Now, what I mean by this is that we not only had the neckline to try and push down through, but nearby and now below was the previously mentioned congestion band between 438 to 445 and 3/4, containing the March, April and June 2013 highs at 442 and a quarter, 442 even and 438 respectively. It looked as if prices had finally managed to break lower in early October, but the market turned back up and back into the congestion, and then fell away again, rolled up and fell away, such that right now prices are sitting back within, well, just below, but mainly back within the 438 to 445 and 3/4 band, yet again. This not only moved the market away from a break lower into a possible false break lower territory, but also created a small reverse head and shoulders pattern over October and early November, with the neckline based on the very same neckline of the larger June to October head and shoulders top, the so far unsuccessful original head and shoulders top pattern. In the meantime, there are some key bearish pressures that prices will have to deal with, ones which I detailed 5 weeks ago, and repeat now, and I quote, "We have overhead a more diaphanous congestion band between 456 and 3/4 and 468 and 3/4, a band that was relatively easier to navigate than the others mentioned, but which now has three key potential bearish pressures within it. They are the declining short medium moving average, currently 442 and 3/4, then the flatlining medium moving average, currently 454 and a half, and a declining long moving average, currently 453. At least two out of these three are descending to impact the market, and one should not take away anything from them, especially any efforts to pressure the market from above." End of quote. The short medium moving average is now down in amongst the previously mentioned 438 to 445 and 3/4 congestion band, and the medium and long moving averages are emerging below the diaphanous 456 and 3/4 to 468 and 3/4 congestion band to hover over the market. The long moving average is highlighted in gold and the medium moving average is highlighted in mauve on my daily chart. However, none of these three bearish pressures have really made an impact on the current market as yet, so we wait. In the meantime, I'll repeat some potential targets below which I laid out 7 weeks ago for the head and shoulders top pattern. Hence, a primary target X would be in the 400 zone, 400 even zone, with a secondary harder to reach target X1 in the 354 even zone. Any move lower towards these would be very, very interesting, as we have alternate neckline 1 currently at 401 and 3/4 and alternate neckline 2 currently at 405 even, both in the way and both originating back from the old November 2019 to February 2020 head and shoulders top. They are highlighted in bright red and bright green respectively. Additionally, there is the December 2020 low at 396 and 3/4, which is also in a way on any move lower. I would further note that these three supports stopped the fall of this market back in May this year. Winnipeg Canola. The recent key pattern here had been the July to late September double top, which we've seen play out to both primary and secondary targets below. Then below that, the neckline, specifically the neckline of the earlier mid-April to early July reverse head and shoulders bottom, which is highlighted in purple on my daily chart, and that's currently at 689.70. After this, what I consider to be one of the more important patterns here, the broken bearish Andrews pitchfork, created by the earlier double top from mid-July to late August move, which is highlighted in bright red on my daily chart. On this last pattern, the market broke up and out on the top side of this pitchfork, but has failed over the last 4 weeks to push up through the green highlighted short medium moving average, currently 700.5, which is a significant failure. Finally, there is the combination of the October to November reverse head and shoulders continuation pattern that can also be seen as an ascending triangle, which admittedly is not the best looking version of this pattern, but it nevertheless is still out there and is highlighted in dark blue trend lines on my daily chart. With the neckline of the reverse head and shoulders continuation pattern currently at 731.10 acting as the flat topside trend line, and the late October uptrend currently at 716.1690, so 716.90, acting as a lower rising trend line. The failure of the testing of the short medium moving average throughout November led to the drop 2 Fridays ago and the breakout below from the ascending triangle. Prices moved down through the purple neckline and even back below the upper tine late last Friday, currently at 652.20, of the broken bright red bearish Andrews pitchfork. Now, my concern for this move low was this could be seen as a precursor for a move down in the other oil seeds and vegetable oils. Now, my thinking was that such a move could be seen as the market seemingly choosing to try and form a bearish halfway hesitation over November with potential all the way down to the 580 zone. Now, this is not a done deal, and I have not placed any targets below, but it is worth considering in the coming days and weeks. In the meantime, let's take a look at the break below the descending triangle and see what and where this leads to. Thus, a primary target was in the 676 zone with a secondary hard to reach target X in the 642 zone. In less than a week after the break low, the market had reached the primary target, and it has not been too far away from the secondary target at 642. It's time now to see if the market makes this secondary target a reality. At the moment, apart from the broken upper tine, the only support that really stands in the way is the June 2021 low at 656, which you can see was the recent low of this market. Now, I would add this final thought. I am increasingly becoming interested in knowing if this contract is really an indicator, a leader, if you will, of what the other oil seeds and vegetable oils may have to deal with. Bursa Malaysia crude palm oil. I have said this so many times, and I'll keep saying it until it is no longer true or valid. But the mid-August to early November 2022, that's right, August to November 2022, over a year old, mildly over a year old, mildly bearish shift pitchfork, the one highlighted in dark blue on my daily chart, is still running the show here after so much time. This mildly bearish pitchfork guided prices more or less lower, initially in between the upper tine, currently at 40.17, and the middle tine, currently at 33.84. Then for a while in May and June, between the middle tine and the lower tine, currently at the lower tine's at 27.52, before prices moved back up again in between the middle and upper tines. The significant patterns within this bearish pitchfork have been the June to September diamond pattern and the recent late July to late August bearish shift pitchfork, highlighted in bright green on my daily chart. In mid-November, prices broke up through the upper tine of this broken pattern, broken pitchfork, broken pattern, as well as the combination of the declining short medium moving average, currently 37.31, the July to date downtrend currently at 35.71, which is highlighted in bright red on my daily chart, and the recent 50% Fibonacci line at 37.06. The rise continued over the medium moving average, currently at 37.59, and the long moving average, currently 37.80, before the capping action seen here in mid-October. Then up over the purple neckline, currently at 38.95, of the recent reverse head and shoulders pattern, before finally running out of steam on the upside at the February 2011 high at 39.53, and the further congestion at 39.86. Mid-November, the market made a seeming lopsided horn top and dropped down through all these resistances that then became supports and are back now again as resistances. The drop has been enough that the market reached down to the broken upper time, which is why I've kept this broken bright green bearish shift pitch hook and the broken bright red downtrend still on the daily chart, despite there being clearly due for potential retirement. Okay, so what now? Well, I am curious as to whether this market will ski down the top of the combination of the broken downtrend and the upper time. Additionally, I suspect, if not key, then it would be significant, and that is the recent 50% Fibonacci line at 37.06. Now, I'm going to pay close attention to these two over the next week or so. This week has been an example of exactly these and what is capping and supporting this market topside. And that's the 50% Fibonacci line at 37.06 on topside, plus the short medium moving average, which is the short moving average as well. Now, whilst below, it has been the lesser Fibonacci line at 35.92 and the support zone seen in late October and September, plus the broken red downtrend and the bright green uptrend that have helped the market.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.